Hey everyone, welcome to another edition of our Smart Investing Weekly Stock Analysis, where we take a look at popular companies that made news throughout the week. And this one made some big news today. I'm going to say in a negative way, and it was a huge COVID stock that was a big benefactor of the stay-at-home play, but gosh, it is not a benefactor of what's going on now. And that company I'm talking about today, Docusign. And while we're talking about Docusign, I want to remind you guys, find this video informational, find it useful, be sure to hit that subscribe button below so you can get access and get reminders about our future videos. But with that, again, let's talk more about Docusign. Ticker symbol here is DOCU. And I don't know, do you have the exact amount they fell today, Bren? I can give it. I'm just curious if you know.
I'm sorry, Chase. I'm just signing some documents here the old-fashioned way. I do not. I believe it was like 42%. I believe was the number. I do not have the exact number it fell today. It was just a huge, unbelievable. When I saw it, I was like shocked. Like, what is going on with this company?
Yeah, I mean, you're right on the dot there. It fell 42.2%. And, this is one thing we continue to point out to our viewers is things are great until they're not so great. And that's what happened with Docusign. And I'm going to say somewhat surprised here because they beat on earnings for the third quarter. So they actually reported earnings per share of 58 cents, which compared to analyst expectations of 46 cents. And they also beat on revenue as it was 545.5 million compared to the estimate of 531 million. Now, I might be saying now, how in the world did this stock price fall? It's because their fourth quarter revenue expectation came in between 557 million to 563 million, while analysts were looking for revenue of 573.8 million. So off the mark there. And that just spooked the heck out of investors, it appears, as they're saying, whoa, that's not the growth we were anticipating.
And this is the problem with growth companies, Chase. I mean, that's only a drop in revenue, about 5%. The justification for have a stocking fall over 40% is just crazy. But this is what happens with growth companies because they never expect that it's going to end. It's going to grow to the moon. And when that doesn't happen, you have this scenario and it catches everyone by surprise. And don't think, I mean, I don't know if you have it there. I think we maybe do. But don't think that you could get out before this happened because it probably opened at a very low. Yeah, so I don't even open that, but many times you think, well, I'll just get out throughout the day. Like, no, it probably opened at down 40% or close to that.
I think I saw a pre-market down like 27%. Again, I do remember seeing it this morning, even before the market was open, that it was just decimated. So yeah, you couldn't even got out, as you said.
Yeah. And then you start playing that game, like, I'll wait for it to come back a little bit before I sell it, before you know it. End of the day, down 42%. So.
And I did find it interesting that the CEO actually kind of came out and said that he was kind of putting fault on the company, so to speak. It wasn't the industry. You're saying it was the company, because he was saying during COVID, they were more fulfilling demand, where before they were fighting for that demand, essentially trying to get new customers, where they had just, I think, this influx in COVID, where they're like, well, not really fighting for the businesses they were beforehand. I still just don't think the growth appetite will be there for Docusign. I use Docusign all the time. I think it's great. I use it for the charity that I run. I mean, it allows me to really get access to people that don't have a printer and can't scan it back. I mean, it's a very easy method, and I think it's fantastic. But I just don't see the demand growing the way that it grew during COVID.
And this is the problem with the growth company, because Docusign's not going anywhere. It's going to be around for many years. But when you overpay for it, I can't wait to look at the numbers, which I know we're going to look at in a minute. I know these numbers were probably way too high. The big question is, with a fall of 40%, has it now become a company on sale? That's a good price. We're going to look at that, people, just in a minute here.
And I did want to kind of bring up too, I mean, you might be thinking, oh, well, now with the Omicron virus and, I call it the Transformer virus, we might be going back into lockdowns. And I do not see that happening. I do not see that being a benefactor for Docusign in regard to kind of scares around the country. I just don't see it being a big benefactor, as I said.
Yeah. So should we look at some numbers?
I think so. Let's pull up the fundamentals as we always do. Again, the company we're looking at here is Docusign. Ticker symbol reminder, DOCU.
Well, and this is surprising to me as well. Short float only 3.7. So a lot of people are not anticipating this at all, which is a surprise. Institutional ownership about 78%. Now, this is very disappointing. No PE ratio. So all this growth, they've not had any earnings from all that growth. Look how expensive price of sales are, 14.4 versus 9.2. Price to book value over 100 versus 9.7, and no price of tangible book value, which means you take out all the intangible assets. There's no value to this company at all. And look at that price of cash flow, 59.6 versus 50.7. Not worthwhile. Now, what's kind of amazing here, the PEG ratio going forward, PE divided by growth, 3, that looks good, but I think that's going to change probably next week. Look at the growth rates here. Now, I'm not sure what's going on here, Chase, but we should, well, no, there's no earnings. So there's no earnings growth for the 1 year, the 5 year. The sales growth is probably why the stock was so high. For the 1 year, it was up 38%, better than the industry at 7.9. Nothing on the 5 year. The analyst, the 5 year estimate on the growth going forward, 46.8%, well above 18%. I believe that's going to come down a lot as well. Unfortunately, no dividend here, so you're not going to get any cash flow from this company. The balance sheet, well, let's see. We got a current ratio of 1 versus the industry at 3.3. I'm okay with that. But look at this debt to equity, 430 versus 100. They've got a lot of debt on this balance sheet, probably growing the business over the year here or two, we'll call it. They've probably taken a lot of debt, which is not good. We do see also, too, that they have a net profit margin of a negative 9.2% versus a positive 3.9. And viewers, think about this. For every dollar they bring in, they'd lose 9.2 cents. That's just not the type of business I want to own, because when you hit the hard times like this is what happens, down 40%. Return on equity, a negative 77 versus a positive 9.6. This is a company that I'm not seeing anything that's going to excite me to get in this business now. What do you got, Chase?
Yeah, I mean, I was definitely disappointed by the balance sheet. I do wonder on that debt to equity if they just have low equity. I mean, we saw the price to book value was very expensive. So as I said, wondering if they have low equity doesn't make an excuse whatsoever to buy the stock, but just kind of curious on that.
Yeah.
Looking at the current price for Docusign, you see it's $135.09. Here you go. 52-week high, $314.76. 52-week low was achieved today of $179.49 as well. So, I mean, we've seen some big issues here with Docusign. Year-to-date return, you see down 39.2%. 3-year return, you see it's still up 223.5%. It had done much better before the major collapse we saw today. But looking forward, again, you can see in the red here, just that dismal day, down 42.2%. We want to look at earnings, though, to see if there is some value going forward. I do see they are estimated to make money. When you're talking about no earnings growth, no PE, I wonder if this was the first or perhaps second quarter now. No, it'd have to be the first quarter that they actually had earnings. I did see it was on an adjusted basis too. So I'm wondering if they're having to back out a lot of different items. So a lot to kind of consider on the earnings picture, if it is kind of what I'm going to call fake earnings. But looking to January 2023 is where we want to go. We see estimated earnings per share of $2.19. I mean, it still gives us, I'm going to say, a laughable target sell price of just $36.35. And as you said, I do wonder if they're going to revise down those earnings even further for a worse target sell price. I mean, you see the forward PE still 62 times, we'll call it. I mean, it's just, there's no deal here with Docusign. I'm not intrigued whatsoever, even with this 42% decline.
Yeah, it just, and I'm sure people are like, oh, it's on sale now. Well, it could be on sale a lot more down the road, because, and we've also seen this with other companies. This could be the start of missing those forward estimates. So you got another 3 months from now. If they miss again, this stock could be not at 135, 150, could be down to 70, 80, maybe 90. So we've seen this happen before. If they can't turn things around, this growth company is not going to be a good company. And I think people are going to be very disappointed with the returns on investment.
And again, I do want to point out, you kind of talk about the growth here. They could still have growth going forward. Don't get me wrong. They could be profitable. They could grow sales at a nice rate. But the reason we don't like growth companies, if you're overpaying for that growth and they achieve growth, well, if it's not the growth that was anticipated, that's the problem that ensues is, well, I thought they were going to grow at 35%. They only grew at 15%. We've seen this with companies like Zoom as well. And this is why, again, we stick to the safe companies, not try and buy these high flyers. I know I'd be livid if I lost 42% today on one of my stocks. It's crazy.
Yeah, and again, that's what happens to the growth companies. That's why we use value companies, because there's something there. And value companies can have disappointing earnings as well, and they miss it. But I can't think of a reasonably valued company that has missed, that has dropped, I'm going to say much more than 10%. I mean, that's kind of a normal 40%. And again, that's down what, over 50% from the 52-week high. What's up 52-week high? Like 312.
Yeah, I mean,
So,
it was definitely up there. So I mean, it's, as I said, I still wouldn't go near it. I'm still going to use the product. Don't get me wrong. Use the service. I think it's great, but the value in the stock just not for me.
yep. And again, we just want to explain to you, be very careful here. This is not a buy recommendation at all. We want to show you these hot companies. We do find some buys for people, but this is just not one of them. Highly recommend staying away from this. And there could be what they call a dead cat bounce, where it goes back
Yeah,
up again. But the fundamentals there are not there to justify the stock price. I'll get great service. Yeah,
yeah.
everybody uses it.
Well, absolutely. Well, I hope you guys found this video helpful today. And again, if you did find it helpful, be sure to hit that subscribe button below so you are informed about our future videos. And maybe go back and look at some of the past videos we've had as well. Could be beneficial in finding some good companies to perhaps invest in. With that too, just as a reminder, this video is for informational purposes only and should not be used as financial advice. If you want to find out more about our investment firm here, Wilsey Asset Management, go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. We'll talk more to you next week.